April 2, 2020, will forever be etched in the annals of corporate scandal. The day regulators in Shanghai unveiled that Luckin coffee, China's meteoric answer to Starbucks, had fabricated nearly 40% of its sales. In the span of just 5 years, a company that once dazzled investors with glossy storefronts and a promise to outbrew the coffee giant had crumbled into a cautionary tale of greed, ambition, and the fragile line between hype and reality. The story begins in 2017 when a small group of former Alibaba engineers, led by former CEO Charles Zhang, launched Luckin Coffee with a bold mission: to dominate China's coffee market through technology, speed, and aggressive pricing. Their formula was simple yet daring: offer high-quality espresso drinks at a fraction of Starbucks' price, and use a mobile-first ordering system to bypass the traditional cafe experience. Within months, sleek, minimalist stores sprouted across Shanghai, Beijing, and Shenzhen, each equipped with QR code menus and a promise of delivery in under 5 minutes. Investors took notice. The company's initial public offering on the Nasdaq in May 2019 raised $561 million, valuing Luckin at over $5 billion. Analysts raved about its unicorn status, citing a staggering 2,000% year-over-year revenue growth and a customer base that seemed to skyrocket daily. The narrative was irresistible. A homegrown Chinese brand built on data-driven efficiency, poised to topple an American icon on its own turf. Media outlets crowned Luckin the new Starbucks of China, and the stock price surged, rewarding early believers with meteoric returns. But beneath the glossy veneer, warning signs flickered. First, the company's reliance on massive discounts and coupons, often up to 50% off, raised eyebrows among industry veterans who warned that such tactics could erode long-term profitability. Second, Luckin's rapid expansion outpaced its physical infrastructure. Within a year, the chain boasted over 5,000 stores, many in prime retail spaces, yet its cash burn was unsustainable. Third, insiders whispered about an aggressive corporate culture that prized growth at any cost, with executives reportedly pressured to meet quarterly sales targets that seemed increasingly out of reach. In early 2020, the cracks widened. Anonymous tips to Chinese regulators hinted at irregularities in the company's financial statements. A deep dive by short-seller research firm Muddy Waters alleged that Luckin had inflated its revenue by billions of yuan, creating phantom transactions to meet the lofty forecasts promised to Wall Street. The firm pointed to suspicious spikes in daily sales, discrepancies between transaction volumes and inventory purchases, and a pattern of ghost stores that existed only on paper. When the Shanghai Stock Exchange announced its investigation in April, the market reacted with fury. Luckin's shares plummeted over 80% in a single day, wiping out billions of dollars in market capitalization. The Nasdaq delisted the company shortly thereafter, and the U.S. Securities and Exchange Commission launched its own probe, accusing the firm of securities fraud. In a stunning turn, former COO Jian Liu was arrested, and several senior executives, including Zhang, were forced to resign. The fallout rippled far beyond Luckin's balance sheet. Suppliers who had stocked the brand's signature coffee beans faced unpaid invoices, while thousands of employees found themselves out of work overnight. Retail landlords, lured by the promise of a high-traffic anchor tenant, were left with vacant spaces and sunk costs. Even the broader Chinese tech ecosystem felt the tremor. Venture capitalists grew wary of backing aggressively scaling consumer startups, and the episode sparked a national dialogue about corporate governance and the perils of overvaluation. In the months that followed, a new chapter emerged. The Chinese government, determined to restore confidence, stepped in with a rescue package that allowed Luckin to restructure under new leadership. The company cut its store count by half, shuttering underperforming locations and focusing on a leaner, more sustainable model centered on delivery and digital loyalty. By late 2021, Luckin managed to return to profitability on a modest scale, but the brand's reputation remained scarred. Consumers, once enamored with the convenience and low prices, grew skeptical, recalling the headlines of fabricated sales and executive misconduct. Academics and business analysts now dissect Luckin's saga as a textbook case of growth at any cost, colliding with regulatory oversight. The episode underscores how a dazzling startup narrative can mask deep-seated fraud, especially when venture capital inflows and market hype create pressure to deliver impossible numbers. It also illustrates the unique vulnerabilities of China's fast-moving consumer market, where the chase for global status can sometimes eclipse prudence. Today, Luckin Coffee still operates, a shadow of its former self, serving espresso to a quieter clientele who, perhaps, appreciate the lessons baked into every cup. Its story serves as a stark reminder that even the most promising enterprises can falter when ambition outpaces integrity, and that the allure of rapid expansion can blind investors, regulators, and even employees to the warning signs lurking beneath the surface. As the dust settles, the world watches, waiting to see whether Luckin can truly reinvent itself, or whether it will forever be remembered as the bold Chinese challenger that overreached, fabricated its way to the top, and crashed spectacularly. Subscribe to The Collapse for more stories like this.